Okay, hi everyone. So we talk about the importance of the exchange rate, the importance of the international trade for an organization. It gives a lot of potentials for a country by doing international trade, visible trade, invisible trade, importing and exporting. So today our lesson objective is mainly to talk about the import export, how to calculate the exchange rate and what is the exchange rate and everything. So when you go to the exchange rate, we can define that is a value of one currency in terms of another. Value of one currency in terms of another, right? If you talk about the US dollar to Sri Lankan rupees, you can see we can talk about easily. We can type it as USD to LKR. If you type like that, you can see the value coming. One US dollar equal 193.29 rupees, like that. So it's value of one currency in terms of another. So this is one US dollar equal to 193 Sri Lankan rupees, like that. So that's the exchange rate conversion. So most of the countries in the world, they do not use the same currency, like China using their country called yuan, or Indian rupees, American US dollars, Canadian dollars, British they are using their sterling pounds, like that. There are different currencies you are using, that everything. Different currencies being used in different countries. You can, with this currency conversion, sometimes in questions in past papers, there are so many currency conversion questions are there right now. Like we talk about the 2019 June paper, there's a currency conversion came from convert the currency conversion from one country. For example, when you're importing from Kenya, how much you have to convert that currency? How much currency you have to convert into the other, right? So this currency conversion actually will be helpful in order to calculate the organization.
Mama Eli and Eric
Organization it's really important to find out the cost of the currency. As a result of that, organization will be able to calculate their exchange rate benefit. If it's a benefit though, if there's a loss. Look at this example. This company, they're going to actually import. How much will it cost to French company, French firm, to buy a goods from a British firm that cost 400,000 pounds? Right? How much will cost for a French firm to buy a goods from a British firm that costs 400,000 pounds? If 1 pound equal 1.20, the cost to the French firm in euro. So now what happened? Now they are going to import some item from Europe. That is countries from French. The foreign exchange is 1 pound equal 1.2 euros. So if you ask what is the strong currency and what is the weakest currency here, strongest currency is, no doubt about it, there is sterling pound. Why? Because one sterling pound here, that is equal to 1.2, more than one of the euros. You can see euro, they have to pay more euros in terms of for one sterling pound. So when you multiply that value with the sterling pound, which costs around 400,000 pounds, 400,000 multiplied by 1.2, in the euro terms, it is 480,000 euros. 480,000 euros. Look at the second example. How many US dollars? How many US dollars will be needed by an Italian firm buying 55,000 euro of goods from an American firm? How many US dollars will be needed by an Italian firm buying 55,000 euro goods from American firm when the sterling pound euro conversion rate 1 euro equal 1.1 US dollars? So here strong currency, you can see euro is a strong currency, US dollar is the weak currency. So euro US dollar conversion, now that also you can see if it is 55,000 euro, I want in US dollar terms, then multiply by 1.1, it becomes 60,500. Okay, now another example, example 3, you can see how much it will cost for a UAE, right? United Arab Emirates in dirhams to buy 300,000 US dollar of goods from US, right? They wanted to buy 300,000 goods from the US. So their currency rate, you can see, one United Arab Emirates, one dirham equals 0.30, that is 30 cents US dollars. You can see here strong currency is US dollar, weak currency is dirham, because it's like 1/3 of the dirham. You can see the value of the US dollar is more than the dirham. So one dirham is 30 cents in US dollar. So here US dollar is powerful. Then cost of the dirhams, you have to divide it. You can see 300,000 divided by 0.3. Answer is 1 million. So that is 300,000 US dollar good worth 1 million dirhams. Okay, like that. So you can several calculation you can do. You can see this case, Ronnie Mackay, this case study. It's a good case. So they're asking different thing. They are PLC. They're manufacturing machines for the agricultural industry, but 40% of the output is sold to American farmers. However, Ronnie Mackay buys materials and components from right. Ronnie Mackay take they are from American firm. They are right. They are taking that different things they are importing from international transaction. So U.S. firm bought machines from Ronnie Mackay costing 3.6 million pounds. And Ronnie Mackay bought components from German firm again because different country when you are doing manufacturing, guys. So normally they have to import from different countries like that. So in this case, they are importing different countries for components from Germany and from Spain, like that from sterling pounds, like that. They're purchasing. So they're asking different question, right? And they're asking, work out the price in US dollars of the machine sold by Ronnie Mackay for the US firm, right? Assuming the rate will be £1 equal US dollar 1.50. Right. For this Ronnie Mackay case study, so first thing, so they ask him to calculate that value. So value is 3.6 million, no? Right? So he purchasing from US, you can see 3.6 million is pound in terms of US dollars. So US dollar currency exchange is how much? 1.5. Then just multiply 3.6 million multiplied by 1.5. If you do like that, you can use your calculator. You can see the answer. 3.6 million multiplied by 1.5 equal 5.4 million US dollars. So it's become 5.4 million US dollars. Right. The second one you can see the work out the amount paid by in pounds by Ronnie Mackay for 2.5 million euro. 2.5 million euro components from Germany. So now there are this current conversion. So okay, say euro to pounds, euro to pound. You can see here. So there are sterling pound conversion. You can see 1 pound equal 1.10. 1 pound equal 1.10. They are giving that thing. Assume 1 pound equal 1.10 euro. So what you have to do now? Then take the 2.5 million euro and divide it by 1.10, divide by 1.10, then you can get the answer from your calculator. 2.5 million divided by 1.10, they're asking the value in sterling pounds, then value coming is not 2.5 million, is 2.27 million. 2.27 million. So how I obtain that value? So 2.5 become 2.27. Why it reduced? Because the strong currency here is pound, sterling pound. The weak currency is euro because they are given the weakest currency value 2.5 million. Then you divide it 2.5 million euro divide by 1.1 the euro exchange rate, and then you can get the sterling pound value as is 2.27 million. And third question, work out the amount in euros, right? Work out the amount in euros uh, received by the Spanish supplier for the 200,000 of materials sold to Ronnie Mackay. Work out the amount in euros received by the Spanish supplier for the 200,000 of materials sold to Ronnie Mackay. Assume they are giving an again exchange rate. Assume that 1 pound equal 1.1 euro. So here, what's a strong currency? Pound is a strong currency, and euro is the weak currency. Pound is a strong currency, euro is the weak currency. So you have to work out the amount in euro. So what you have to do now? Now you have to multiply because they are given the strong currency value, 200,000 pounds. So if you want to take the weak currency value, you take multiply that. So I'll give a hint. If you want to take the weak currency value, multiply. If you want to get the strong currency value, divide. So here we give the strong currency value. So then multiply it 1.10. Then you can get the euro value. It becomes 220,000. 220,000. Right. Let's move on like that. This is a currency conversion thing. It's not that much difficult. It's small, right? It's basic calculation, multiplications and divisions only. Right. Let's move on to the other parts. The impact of exchange rates, the impact of exchanges in the exchange rate of importers and exporters. What kind of impact is there? for importing and exporting. So there are two things can be happen from importing exporting. One in fall in exchange rate, another one is rise in exchange rate. Right, this situation we call depreciation and appreciation in other terms. I know some of you might doing economics, you must have a knowledge about in economics, but here again you're talking that part exchange rate appreciation and exchange rate depreciation. When countries value currency going down, which means like in terms of a foreign currency, if you have to pay more to buy a foreign currency, we call that fall the value of the exchange rate or value depreciates. So there are some impacts are there for importers as well as exporters. In my first of all, I told you this situation. Look at the situation now. What happened? Like 1 month ago, 30th of December, you can see the currency was. Look at this 1 month rate. Let's say 1 month situation. Okay, now the it was 187. This is December 20th, 1 month ago. Now today, the January 20th, 193. This case, what kind of situation you can see? The value, rupee value, appreciate or depreciate? Yeah, I can see the answer. Someone commenting, it value depreciate. Yes, you are correct. Very good. Because you can see when the rupee value going down, like for to buy $1, you have to pay more rupees. That means our currency becomes so weak. Our currency becomes so weak. I'll show you another currency, say US dollar to Indonesian rupiah, right? Indonesian rupiah. So imagine 14,062. 14,000, you have to pay $1 equal 14,062 Indonesian rupees. 14,000, imagine. Some currency like Indonesian rupiah, it's like that there are some currencies even less than Sri Lankan rupee. Let's say you compare Sri Lankan rupee, LKR to Indonesian rupee. How much? It's 72. Our Sri Lankan 1 rupee equals 72 Indonesian rupee, which means if you take 1,000 rupees Sri Lankan rupees to Indonesia, it's become 72,000. It's become 72,000. If you bring 1 lakh rupees, how much? It's 72 lakhs. 1 million becomes 72 million. It's like that. So Sri Lankan rupee is strong, Indonesian rupee is weak, right? So like that, there are some countries less than Sri Lankan currency, that is weaker than Sri Lankan currency. So both of these countries you can see developing sectors like that. But compared to US dollar to Indonesian rupee, you can see as I show you, USD to Indonesian rupee, you can see if you have to pay 14,062, 14,000, $1. So $1,000 mean how much? Is millions, guys. So that's why the foreigners can do anything in their country easily because the currencies and the prices are so cheap for them. The currency conversion, they can have millions of money with them. That's why the tourism, everything was very good in that country, Indonesia, and investment also very easy for them. And the land prices, everything. A lot of people are went to Indonesia to purchase some. There are so many investments going on right now. Indonesia, especially the palm oil and other industries are going on, and mainly a good country for tourism and also other industries as well. So this is the impact of foreign exchange falling like that. So if foreign exchange falling, that becomes so cheaper to other countries, that local currency becomes so cheaper for other countries. As a result of that, what happened? The prices of exports and imports also change. What kind of impact is there for exporters? Exporters has is good for exporters. Why? In return for them, they can convert more local currencies as a result. If UK firm sells good worth 2 million to US customer, the dollar price of the original exchange rate, they say US dollar 3 million, that is we multiply by 2 million into 1.5, the exchange rate falls, the dollar price of the goods also falls. This means that the demand for UK export is likely to rise because they are now cheaper than they were before. That means then the situation of a currency fall or depreciation is good for the exporters. Good for the exporter because their export prices will go down and become so cheaper for the foreign currencies. But on the other hand, the foreign exchange, you can see the import section, the importers actually has to pay more rupees or in their local currency, in terms of local currencies, in order to import a lot of items. So import prices become, the cost of import will go up. Therefore, they discourage and it's bad for the importers of falling exchange rate. Then we have to pay more amount of money in order to import something to the local country, and then but exports on the other hand, by selling their items abroad, they can convert more local currency in return. That's the thing. So having always dollar terms is actually having US dollars or whatever the strong currency is export in some way. That's why some countries having always the depreciating policies sometimes is good for them, because if the country is having more export like tourism and everything, like for country like Sri Lanka, currency, the falling exchange rate is good for tourism industry, because the people in like hotel sector, they can have more rupee income in terms of dollars, because all the like dollar rates are not changing. If they are charging say $150 per night uh, for like a full board package, you can see the rupee value will again what happen, will increase. Exporters is good for the exporters but bad for the importers. Then what kind of impact is there for the rising exchange rate? There is a opposite. It's good for the importers, bad for the exporters, because then what happens, the value will go up. As a result, what happens, the amount of money that you are taking in return of the foreign currency, the amount of money is like that, it's going opposite way. It's going opposite way. Let's say USD to LKR, this case now 193. So this case you can see now this case rising 187 to 199, but there's a time when 189 gone down to 185. So this case you can see when currency value going down like that we call appreciate. When currency value going up we call depreciate. Now what happened? Now is a really depreciating situation. This is 180 is to they jump into 193. Right? If you talk about the 5 years, right? 5 year situation, we can see it's appreciated. The trend line being 141 in 2016, and now after 5 years, you can see it's 193. So value always increasing, increasing, increasing. There are certain ups and downs that are there, but you can see the trend line. If you compare the 5 year trend line, value depreciate, rupee value depreciate. Every year it's like 10 rupee, 10 rupee, 10 rupee. You can see value depreciated. So this is good for the exporters but bad for the importers. Why? Now we have to spend more amount of rupees in order to import. So cost of import will increase. So imported materials, imported items will increase. Inflation will be happen. So what happens? So everything, all the foreign items will be increased in locally as a result of that. Right? So this thing we actually summarize in this table. You can see the exchange rate falls. As a result of that, the price of export will fall, demand for export will rise, and price of imports will rises, and also demand for imports also falls. So this one I summarized again. Exchange rate fall or depreciate, always think it's good for the exporters because of the cheaper value, and when exchange rate rises, it's good for the importers because the cost for, you can see, import cost will be demand for import will rise as a result of that, because it becomes cheaper to importers when exchange rate rises. That's a summary of importing and exporting, guys. Right. So again, I like wrap up the lesson before we go to the next one. What we talk about today, the exchange rate. We talk about the exchange rate conversions. Exchange rate conversions can be done in different ways, right? There are so many examples are there, like MCQ questions and calculate questions. 2 markers, 1 markers can be there in India. Papers about this. There are, we analyze the papers, like every paper you can see kind of exchange rate question like that. Sometimes you have to divide the currency with the given exchange rate. Sometimes you have to multiply the currency. So division and multiplication, you have to think clearly why we divide one currency, why we multiply one currency, right? If you, because asking, if you're asking some kind, look at this situation. This case they multiply. Why they multiply? Because they ask the, right? They're asking strong currency to weak currency. They gave the strong currency, pound, and they asked the weak currency. If you want to convert to strong currency to weak currency, you have to multiply, right? And this third situation, why they divide? Why they divide? Because they have asking from strong currency, they are asking then weak currency. Again, that case they are given the value of the strong currency, and they are asking value of the weakest currency. In this case, they divide. So 300,000 US dollars, they divide by 0.3 because the exchange rate given in terms of a US dollars. So they divide with that value. So always keep in mind, the given exchange rate, if you're using, you have to use it wisely. Whether you're going to divide it or whether you're going to multiply it, it's based on the currency conversion, the weakest and the strongest. There's a relationship, right? And after that, we talk about this conversion, this activity number two, the Ronnie Mackey case study. There also we discussed a little bit like a currencies given situations, different currency values they have given, right? Strong currency values and weak currency values, and we multiply and divide, right? So finally, we talk about the appreciation and depreciation, the impact of exchange rate for different things, especially for importers and exporters. So summary is, guys, here is fall in exchange rate is good for the exporters, rise in exchange rate is good for the importer. That's a summary, right? Exporters will be that export will be cheaper for the foreigners. Therefore, demand for export will go up. As a result, more export mean more income and more currency you can convert. In this case, rising imports, because imports become cheaper, because cost of import will go down, then demand for imports will increase. As a result of that, imports become cheaper, and then a lot of imports will increase. As a result, they encourage to import more. So this is the summary of that lesson. Okay. So I think the exchange rate conversion and impact of exchange rate is clear for you, right? Then from that, uh, we'll move on to our past paper discussion. With that session.